The conservative manifesto is a word that Doug came up with. What Jack and I have been calling it is a growth task force. And there are 320 caucuses in the House. You can go on the House Committee on House Administration and get the full list of 320 plus caucuses, including things like my new favorite, the cut flower caucus. But there's not one that deals with economic growth. And the only problem our country has, when you get right down to it, is a lack of economic growth. More specifically, a lack of growth that lifts income for everybody. So if we can create robust growth that lifts income for everybody, we're going to be able to solve every problem you can think of. In fact, if you take out a sheet of paper and you write down Obamacare and EPA and this and the tax code, and you get about 50 things on that sheet of paper like I did, and you get depressed and you stop writing things down. But every single one of those things can be traced back to a lack of growth that lifts income with 100%. So I wanted to try to figure out a way, how do you make this more urgent than it is? Because it always seems like there's a pressing thing. We got to fight Obama on this. We got to take a stand over here. We got to, and it's all reactive. Nothing puts us on offense. So imagine if you woke up and you read these headlines in the paper. Bold headlines: enemy forces attack the U.S. Strikes target the economy's productive base. Damage exceeds the cost of all prior wars combined. The hit to GDP is expected to be $9 trillion, 7 times more than the financial crisis. In response to that, Democrats promise relief, increase government spending. Republicans want to balance the budget. I mean, doesn't that sound out of whack? Well, that's exactly what's happened. If you take our trend growth from 1790 to 1971, we grew at 3.955% reliably for 180 years. Since 1971, a gap has opened up where we dropped below that trend line. And if you measure the distance between where our GDP would be had we stayed on that trend line and where our GDP is now, it's $9 trillion. Why isn't that front page news every day? Congressional Research Service did a report in 2010. They went back and took the military cost of all wars from the Revolutionary War and every war up until Iraq and Afghanistan, adjusted it for inflation. That's only $7 trillion. We've taken a $9 trillion GDP hit, which exceeds the cost of all that, and we can't get people excited about making economic growth the number one priority, because that's the only thing that's going to solve our problems. Part of it is we have to unlearn some things that we think we know about economics, or at least that we were taught about economics, in order to do that. So Jack and I have been working on members of Congress to put a growth task force together. And we'll kind of walk you through the outline that we're proposing. And it just basically says, can we solve our problems with growth? If so, how much more growth do we need? Now that we know how much growth we need, how do we generate that growth? How do we ensure that growth benefits the 100%? What specific policies offer the most bang for the buck? How do you communicate a growth agenda to the electorate? And then how do you overcome all of these built-in obstacles and booby traps in Washington that stack the deck against growth? Because if you can't handle the last part, then all of the 6 previous questions are just interesting conversation, academic debate. So fortunately, a new caucus has been formed, the House Freedom Caucus, chaired by my favorite congressman, Jim Jordan. Any Jim Jordan fans here? And Jim's indicated that he's going to go forward with this growth task force. So this will be the world premiere of what the outline and structure of this task force. On the first question, can we solve our problems with growth? There's a simple exercise you can go through, is take the CBO long-term forecast, and you can hold constant the rate of economic growth, and try to cut spending and see if you can solve the problems. If you cut spending by 3 percentage points, 3 percentage points of GDP, think of the fight we had over the sequester and all that, and we're talking fractions of a percentage point. If you cut by 3 percentage points, you still don't solve the problem. If you hold constant the spending in that forecast, and just assume that's what we're going to spend, and you increase the rate of economic growth by just 1%, you solve the problem. If you increase taxes, it makes the CBO numbers look a little better in the early years, but then things blow up faster in the outer years because that's going to sap our economic growth. If you look at the differences between the impact of cutting, where you're now looking at a series of benefits years into the future, and you take a present value using whatever the government bond rate is, increasing growth has 27 times the impact of reducing spending by the same magnitude. So if you increase growth by 1%, it has 27 times the impact of cutting spending by 1% of GDP. So even a Democrat knows that 27 is greater than, if you had a choice between doing that, which is 27 times more effective, or that which is 1/27th of the impact, it's a no-brainer. So the first question is a resounding yes. You can solve the problem. The next question gets a little disappointing. How much more growth do we need? Anybody here know?
That's 30%.
30%, like we're growing at 2.2% now is kind of the trend. So 30% more would be like another 0.6.
1.7 would be.
Well, here's the thing, nobody knows.
Well, if you said where the trend line before was 3.9 and it's,
Well,
then
so we
that
certainly
would be
have the capacity to
1.7.
grow at more than that to get back up
But
there.
I'm just saying, it's like that would continue the
But
trend
here's
line.
the sad reality. Nobody really knows. And how hard would it be to call on the Social Security trustees and say, I want you to run your actuarial model backwards, and you tell me the rate of growth necessary to fund entitlement programs without benefit cuts. And instead, they assume 2.1% growth over 75 years. And we're surprised that the country implodes? I mean, we're just not built for stagnation like that. At 3.9, things worked that we were the best country in the world for a long time. Nobody even came close. At 2.2, we're not going to survive at 2.2. So what happens is they have an actuarial report that's dripping with red ink that then gets fed into the CBO, and the CBO says, well, we use a different model for economic growth. We're going to assume 2.2%. But they just assume the outflows that the Social Security trustees give them. And as soon as you accept the rules of the CBO and the budget committee, then our poor budget chairman is handcuffed. I mean, if you swallow a false premise early on, you're not leaving yourself any good options no matter what. And then we say, well, yeah, sure, we can make this balance. Here's $5 trillion of cuts. And what has that gotten us? I mean, we lost a special election in New York on that very issue. We lost the most winnable election in the history of the country because we proposed to accept stagnation and cut. And we'll get to a reason here in a minute why the electorate is so opposed to cuts. First of all, the electorate knows better. The electorate knows we can grow our way out of this. So when we ignore growth and follow all these silly rules and say, here, we can do this with cuts, I think the electorate knows better. So we need to establish a target growth rate, and everybody should know it. I mean, that should be the goal. The Social Security trustees can give it to us by running their models backwards. It's probably going to be between 1% and 1.5% more than what we have now. If you go back to the 90s, the closest thing that you can do is read their trustees report from the mid-90s, and then read it the next year where you know the rate of economic growth in between, and see how many years into the future the obligation, the D-Day was pushed. And then the next year, you know that we had decent growth the next year, and it was pushed out a few more years. So somewhere around the growth of the 90s, we'll keep deferring doomsday. And if we could just sustain growth like that, that's kind of the first step. So the answer to the second question is probably at least 1% more growth to 1.5. It's sad that we don't know, and everybody in the whole world should know what our target growth rate is. You get to the third question, and that is, now that you know how much more growth you need, how do you get there? And here there is so much confusion, so much misinformation about how you grow the economy. You talk to the left and they say, well, of course, spending. Consumer is at 2/3 of GDP. So if you want more GDP, just increase spending. And oh, by the way, you greedy people, if you're going to save your money, we'll redistribute it from you, so we'll give it to somebody who will spend it. Right? And how did Nancy Pelosi saying food stamps are an economic stimulus? They're stuck in this trap that says when you spend money, it drives the economy, which is a superstition. If you want to prove it to anybody, if you get into these arguments with your friends on the left, have them prove it empirically. It's never been proven empirically. All you have to do is ship them to an island of Alaska where they're the only market participant on that economy. And say, okay, smart guy, show me how you can consume something before you produced it. And pretty soon you realize you can't consume anything until it's produced. And if you add 2 people to the island, it doesn't change it. You still have to produce, and I still have to produce, so that we can exchange our production. If you have 10 people or 300 million people, it's no different. You have to produce first. Then and only then can you get paid. Then and only then can you consume. So think of the train. Production pulls along consumption the way an engine pulls a caboose. The left thinks the caboose pushes the train down the tracks, and we know the engine pulls it. So if the engine pulls the train, what fuels it? And business investment is the only thing that fuels production. If you want a different way of looking at GDP, all the textbooks start out by saying GDP, they show this equation, and they say GDP equals consumption plus government spending plus investment plus net exports. You add all that up, it does add to GDP. But that's like your pay stub. It tells you what happened to what you earned, what happened to what you produced, where it went. So all that does is measure GDP that was produced. It doesn't say a thing about how it was produced or the conditions under which it was produced. If someone looked at your pay stub and said, to increase your income, all you have to do, Sam, is increase the direct deposit amount. You're like, thanks, I'm paying you for that advice? Or they look at your pay stub and they say, you can increase your income if you just increase the taxes. It's completely backwards, but that's what is ingrained at the Fed. That's what's ingrained among the left, the Paul Krugmans of the world. And we need a way to defeat that. Otherwise, it will get into this. Yes? Oh, okay. One way to defeat it easily, yes.
I was going to say, is this the result of Keynesian economics,
Oh, yeah.
basically? It's
Yeah.
like, that's all this is. And it's one of those things, rhetoric, no data to back it. It's
Right.
frightening.
And it's pure superstition.
Mm-hmm.
An easy way to defeat it is look at the economy the way you would look at a business. And with a business, it's common to use a return on asset equation. What are the company's income or revenues relative to the assets? And if you want to expand the revenues or the income, you at some point have to expand the assets. Well, the economy is really just the sum total of every business. So what works for a business should also work for the economy. The Keynesians somehow invert it. You can't spend your way to prosperity, but somehow the government and the economy can. There's this black hole somewhere in their theory. So just take GDP relative to assets. Assets are what produce GDP. Nothing else can produce GDP. And we have residential assets and non-residential assets, and conveniently, they're broken out in separate categories. So next, all you have to do is take GDP and break it out into residential and non-residential. And fortunately, they break out residential. So you can take GDP minus the residential component of GDP, and what's left is non-residential GDP divided by non-residential assets is a fancy way of saying when businesses invest, how much GDP does it throw off? And it's 45 cents. So the GDP return on non-residential investment is 45 cents in the dollar. The GDP return on residential investment is 7 cents in the dollar. There's the growth equation for you. Even a Democrat knows that 45 is greater than 7.
Well, maybe.
And if we can engage them on that debate, they're going to look silly, saying, oh, no, but we still need to subsidize housing and all this other stuff. So every dollar of business investment generates 45 cents of GDP. You can work backwards. So if our target growth rate is 1% more than what we have now, and GDP is 17 trillion, if we need 1% more of 17 trillion, that's $170 billion. If every dollar of business investment generates 45 cents of GDP, we need something like 380 billion of business investment. So if we get 380 billion of incremental business investment, we'll grow at 1% more, and that's enough to solve our problems. So the conversation should be, how do we get more business investment? If you ask business, they'll tell you the same things they're saying now. A new tax code, roll back the regulations, repeal Obamacare, which now starts to play on our home field advantage, as opposed to constantly reacting to all the stuff that the left puts out. The fourth question is, all right, we know growth can solve the problems. We know we need at least 1% more. We know how to get there, a certain amount of business investment. How do you make sure that growth benefits the 100%? Because if we're leaving people behind, we're losing support for the policies that we want to enact. And this gets us to the slide here. This chart shows from 1948 to 1971, income for the top 10 versus the bottom 90. And you can see over that 23-year period of time, income for both groups went up more than 85%. That was the golden age of the middle class. That's what everybody thinks of when they think of American prosperity. Something happened in 1971, and since then, the trend is flat for the bottom 90, and it's doubled for the top 10. That picture of 40 years of income stagnation for the bottom 90% of the country is why we have a spending problem. It's why we have a deficit problem. It's why we have a debt problem. It's why we have a food stamp problem. It's why progressives get elected in the first place. Stagnation is the miracle grow for the spread of progressivism. Right? Prosperity is the sunlight that completely arrests and eradicates. And if we can fix that, then we'll begin to earn the political power and the mandate to enact all the reforms that we need to enact. Back in 1960, right around here, John Kennedy ran on a platform of supply-side tax cuts, a stable dollar, free trade, strong national defense. Sounds pretty conservative to me. And because everybody was prospering at that point in time. And the Democrats were really the party of growth, and the Republicans were more a party of austerity. Democrats had the president, the Senate, the House, majority of governors, majority of state legislatures, majority of Supreme Court appointments, majority of Federal Reserve appointments, were all Democrat. Obviously, Johnson lifted to the left. We had murderer's row of economic policy of Johnson, Nixon, Ford, and Carter before we got Reagan. And Reagan ran on supply-side tax cuts, a stable dollar, free trade, strong national defense, made those conservative policies. Reagan demonstrated that the Republicans had now figured out how to generate growth so that it benefits everybody. And by 2000, the electorate gave us President, Senate, House, governors, legislature, Supreme Court, Federal Reserve. All 7 levers of power were clean sweep Republican. But we failed to deliver the income growth to the bottom 90, and we lost our power and mandate just as quickly, and that's why our brand is tarnished. If we can figure out how to solve this, then I think we're on the road to the kind of power we need to enact the kind of reforms that we need. So, Jack, by the way, here's where we changed the Federal Reserve. In the prior period, the Fed had a mandate to stabilize the dollar. They paid no attention to labor markets. And the average person had no clue who the Fed chair was. The Fed chair was no more significant then than the chair of the Office of Weights and Measures today. Yet, every day, that person comes into work and leaves an hour exactly at 60 minutes and doesn't give in to the temptation to play master of the universe and try to adjust how many minutes are in an hour in order to improve the economy. But the Fed does that relentlessly with the value of the dollar and at significant cost. At 1971 is when this gap started opening up in our growth rate. How do you grow at 3.955% for 180 years and then lose a full percent since then, 2.8% since then, and 1.7 since 2000? A lot of it has to do with the floating dollar. It chases investment away from productive activity and chases it into hedges and shelters and things that protect from the chaos of the floating dollar. We just covered a few minutes ago that every dollar of business investment generates 45 cents of GDP. We should be figuring out how to maximize investment. Instead, with a dollar that is volatile, it chases money away from where it would otherwise generate 45 cents of GDP into things that are designed just to protect against chaos. Yeah.
When did Ben Bernanke come into office as the Fed chair?
That was around 2002.
So it was well on its way already by then.
So in the prior period, when you had prosperity, inflation was defined as a decline in the value of the dollar. So the Fed would pay attention to markets, and it would add liquidity if commodity prices went up. It would drain liquidity if commodity prices went up, and it would add liquidity if commodity prices fell. They paid no attention to labor markets. Since then, on that side of the picture, they've shifted the focus, where now inflation means an increase in the CPI, the Consumer Price Index, or the Fed's favorite measure, the PCE deflator. And these knuckleheads at the Fed get together and say, okay, if the goal is to stop that index from going up, how do we stop it from going up? First of all, it's a lagging index. It comes out well after the fact. It's subject to constant revisions. It's based on sample data. There's all kinds of these statistical adjustments to it. It's just price indices are lousy to begin with. So these knuckleheads sit around and say, well, if we're trying to stop that index from going up, let's take a look at what's inside that index. And maybe if we can look at what's inside it and keep that from going up, that'll stop the index from going up. So they look inside it and they see it's apparel and food and beverage and transportation, medical products, and all the stuff that we buy. Within each one of those categories, food and beverage, for example, they look inside there and say, well, what goes into the food and beverage category? Well, it's everything in the grocery store practically. And if you keep peeling away the layers of the onion, you get a pile of commodity costs, input costs, material costs, and a pile of labor costs. Every product in every category in the index is some composition of material costs and labor costs. And the Fed looks at it and says, well, boy, it's pretty clear labor costs are the larger of the two. So if we can just keep this from going up, we'll keep everything in that index from going up, and we'll be able to achieve our price stability goal. What they don't realize is they've adopted this practice of treating wage growth as inflation. So we get good economic growth. When it starts to lift wages, the Fed stamps it out, puts us in the next recession. And if you zoom in on this period here, from 82 until the present, it looks like that. That's the magnified version of it. Reagan's tax cuts went in full effect, and like clockwork, immediately, income for the bottom 90 started growing. It grew 6.5%, and the Fed said, it's enough. We don't want that lagging price index to go up that's made largely of labor costs, so let's raise rates 9 consecutive times, as many times as it takes to stamp out the prosperity, to create slack in the labor markets. Put us in the next recession. At the bottom, you had the House Republican landslide. And by the way, these arrows are as close to the actual time they took place. I didn't just kind of casually put them to where they look best. House Republican landslide, capital gain tax cut. The greatest prosperity in the last 40 years happened in the late 90s. Income for the bottom 90 went up 13%. At the top of that trend, Clinton had a mandate so strong he withstood impeachment. So if we want a mandate strong enough to do the things that we need to do, there's a formula right there. Deliver prosperity to the bottom 90. The Fed got to a level and they said, that's enough. 6 consecutive rate hikes, despite the fact that there was not a sign of inflation anywhere. 6 consecutive rate hikes put us in the next recession. Along came the 2003 Bush tax cuts. They worked. By the way, they delivered the only prosperity the striving majority has seen that decade. Fed stamped it out with 17 rate hikes, and now you see where we are now. And if we want to go to the bottom 90, where $1 of their 1982 income is at 97 cents, and say, hey, I think we need to cut, we're just selling the wrong product. You know, we need to sell income growth to the striving majority. The bottom 90% is the largest political demographic under the sun, and income growth is the one thing that everybody wants. So why spend all the money on pollsters to say, well, what do you think about this issue? What do you think about that? What do you think? Why don't we just say, hey, are you in favor of income growth? Are you in favor of income growth? And the simple question is, when your income goes up, is that good or bad? We all think it's good, but do you realize that the Fed thinks it's bad? And they're really the only vote that counts, because they're the only entity on Earth that's capable of counteracting everyone's personal drive to do better next year than you did this year.
Well, okay, so this does sound good and all, but then that's amazing. So then how do we reverse the Fed philosophy?
Perfect segue. Next question of the Growth Task Force is, what policies have the most bang for the buck? So hopefully by now you see that stabilizing the dollar is an order of magnitude, or maybe several orders of magnitude more important. It is the most important thing that Congress can do, is to stabilize the dollar. That would remove the Fed from labor markets, so that when wages do start rising, right, and there's some early signs that they might be creeping up a little bit, but if you listen to all the stuff the Fed talks about, they're like, well, we don't have to raise rates yet because, you know, wages are still stagnant. And nobody calls them on that and says, well, what does that mean? Does that mean if wages pick up, you are going to raise rates? So you have to stabilize the dollar. That does two things. Gets them out of labor markets, which is the only way, Jack, go back to the last one. It's the only way that you're going to get this kind of growth. And that's what we need. The second thing it does, it will generate immediate growth. On the announcement that the Fed is going to stabilize the dollar, you're going to have hundreds of billions, if not trillions of dollars from all over the world that will get flushed out of all the hedges and shelters and derivatives and hard assets and things that are not productive assets, but they just protect against the chaos of the floating dollar. That money's not going to have any need to be there anymore, and it will get flushed out. And it will have no other place to go than to fund productive investment. And backing up to comments earlier, every dollar of that is going to generate 45 cents of GDP every year until the cows come home. So that's number one. If you want to look at it a different way, and say, if I gave you a magic genie and you had 3 wishes, what would you wish for to get economic growth? Anybody? What else should we do?
Reform the tax code.
Tax code. That's a popular one. What else?
Allow the companies to bring their assets from overseas back here and invest.
Okay, repatriate foreign earnings. What else? There you go, EPA regulations. We love
Get rid of
Obamacare.
the
Okay. So let's say you could do all that. You scrap the tax code and replace it with something sane. You roll back the regulations, you repeal Obamacare, you do all of that. It will indeed generate strong growth, maybe the best growth we've seen in years and years, even a generation. But as soon as income for the bottom 90 starts going up,
Stop the Fed.
this line will get up to about here, the Fed will say enough's enough, they'll raise rates, they'll put us in the next recession to create slack in the labor markets. That line will go back down, and the left will say, we did everything you right-wing knuckleheads wanted. And what did it do? Other than help the people at the top and continue this sideways stagnation for the bottom 90. Now, of course, it has nothing to do with our policies. In fact, supply-side policies were the only things that worked. Can anyone point out when a demand-side tax cut was done? They don't show up because they don't work. 2001, we did one. How'd that work for us? We did it right there.
Right down.
2008, we did one. How'd that work? Supply-side tax cuts are the only thing that works. Supply-side policies in general that respect the fact that production drives the economy, that business investment is a fuel for it. The only things that work, it's not our policies that there's anything wrong with. It's the Fed. So that would be number one. Let me take this question.
Is there any way to rein in the Fed? Do we need the Fed?
That might be a topic of a different presentation next Blizzard we have.
I mean, I think we need something, some organization
You need
that give that
But
purpose
not
is
this-
to at least stabilize the dollar, but that just gives them that sole purpose and
Well,
make
it's like
it
the
very clear.
IRS.
that-
It's like
You
it's
need a lender of
its
last
purpose.
resort.
Yeah,
The
it's like.
Fed could be a lender of last resort. We had a stable dollar for 80 years before we even had a Fed.
Yeah.
And during that period of time, we had like 4.3% growth for 80 years with a stable price level. So the Fed is too involved in the economy to just think that we can end the Fed. We have to do it in steps. And the first step is to stabilize the dollar, which would generate growth, deliver income for everybody. The more people participate in prosperity, the more they'll vote for policies that continue the prosperity. And in effect, what you've also done is you've eliminated their discretion. And if you eliminate their discretion, that's where you'll get some additional bang for the buck, because we didn't have financial crises from that period, 1948 to 71. We didn't have one. Like clockwork, we have one every 4 or 5 years, since then. Did you have a question back there?
Yeah, I don't quite understand if you have this historical reference, what is the Fed's motivation?
I wish I really knew. I mean, I can tell you what I think it is. They're just indoctrinated in this Keynesian superstition. And if you think spending drives the economy, then when the economy slows, you're going to think, hey, if I lower interest rates, it'll make it cheaper for people to borrow so they can go out and spend. And,
But
I mean, despite
there's-
that sounding silly on the surface,
But
that's
it doesn't work.
Well, that's not entirely true. It depends, it depends on the definition of the word is, what the definition of the word is. And when you define, you have to control inflation. And you define inflation as a change in this index. The Fed has been spectacularly successful. We had a decade of chaos back, from 71 until about 1982 or something like that, where we had, if you remember, the inflation was 21% and whip inflation now, and all of that kind of stuff. And then the Fed came in and established order by controlling the index. And we simply haven't had inflation, by their definition, since the early 80s. And in fact, there are brilliant economists.
despite the fact that they caused the inflation.
Yeah.
Yeah, well, it's like, giving the arsonist a medal for calling the fire department after they set the fire, okay? But the fact of the matter is, from their perspective, the Fed's done a great job.
Here's what they'll hang their hat on. Prior to having a Fed, you had more volatility in the economy. You had a panic about every 3 years like clockwork. Every 3 to 4 years you had one. After the Fed, that got elongated into once every 4 or 5 years. And in kind of the post-71 period, it's more like one every 8 years. So they use that to say, we're a good stabilizer here. I mean, we kind of know when to pull back on the reins and when to, you know, but the fact of the matter is it's come at the expense of economic growth. What would you rather have? 4% average growth with more volatility? Or 2.8 with less volatility? I mean, it's a $9 trillion gap between this trend line and where we are now. And it comes at a huge, huge cost. And this is a debate that we need to have, but here's the problem we find. Most of the guys we talk to in Congress serve at the state and local level before they make it to Washington. And at the state and local level, you deal with every policy issue except one. Well, except, you know, national security too, so except two. You deal with budgets and taxes and spending and regulations and everything like that. You don't deal with monetary policy. And for good reason. I mean, would we really want the 12th District Federal Reserve in San Francisco to devalue the 12th District Federal Reserve note to make it easier for California to pay its debts? Right? We would instantly impoverish the entire state if we did that, drive all the investment out of there. I mean, that's easy to see that that's just a stupid idea. But somehow the Fed thinks it's a great idea to float, you know, the dollar against everything else. So, I mean, it's a debate we need to have. We find that most of the guys in Washington, I say guys generically, guys and gals, there's this factory installed blind spot. They haven't dealt with it in their prior experience, so they run their first campaign. They have all their strong suit, their talking points. They're obviously good enough to win an election on not needing this to win an election. Then they get to Washington, they see that it's important, they try to engage, and then they get outmaneuvered by, you know, the hecklers. That if you talk about the Fed, they're like, oh yeah, well, what about the panic of 1872? And then they retreat into their comfort zone and say, I obviously don't know enough about this subject. And it also can get technical and esoteric. So having a Centennial Monetary Commission, a bill introduced last year, Jack and I were able to get a number of co-sponsors for it. That's one solution. Let's put monetary policy on trial. This is way better than the audit the Fed bill, by the way. Let's put monetary policy on trial, where you can have advocacy on both sides. You can have rules of admissible evidence, and you can take testimony, and you can have cross-examination until you get to a point where you have a finding of fact. And if you put this on display, there's no way that the current system can stand the scrutiny. And because of that, the Fed will fight tooth and nail against it, the way they're fighting the audit bill. But, I mean, that's basically their argument, is that because of them, we have fewer recessions, we have elongated, smoother business cycles, as opposed to more volatile business cycles. Well, it's like, would you rather have your income grow at 10% a year in a volatile fashion, or 5% a year in a less volatile fashion? I know what I would take every day. The volatility doesn't matter. The compounded rate of return is the only thing that matters. Did you have something you wanted to
I was just, you know, one thing that I always find is helpful in, you know, this discussion, when you look at that red line that's been, you know, flat or actually negative now with the current administration for 40 years. A couple of years ago, there was polling data that came out that said that young people believe that there's no difference between socialism and capitalism. And I remember hearing that the first time and thinking, oh, our education system is so bad, it's terrible. They're not learning what they should learn. Well, the fact of the matter is, no, they're right. Based on the experience of their families, there is no difference between socialism and capitalism. This is the mechanism by which the statists control the economy and create the stagnation that creates the need, as Rich said, it's the miracle growth of progressivism. This is the political tool that they use. Now, are the people at the Fed evil? Well, there probably are a bunch of evil ones in there, but they're not. You know, they're just indoctrinated in this completely, essentially fictitious, you know, economic theory. And, you know, that's been the task that Rich and I have had, that we've tried to, you know, take to Capitol with a fair amount of success. There's a lot of people, once you show them this, that say, my goodness, this is reality, what we've been told isn't.
And, one thing I would add to that, kind of the clear business model on the right. If you get a mail list, you get donations of $10 and $25, you use the money, and it's pressure, 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 pressure. And the way you raise money is you show that you can put more pressure on these guys. There aren't many people, I don't see any, that are trying to help these guys. Everyone wants to put pressure on it because that's the proven model. And as a result, that's how they respond. They respond to pressure. It takes them a while to kind of come around to like, so who are you guys and what do you want again? It's like, we're just trying to help you guys. Understanding economic growth is fairly simple. But there's some things that you have to unlearn in order for the picture to go on and say, this really does make sense.
Yeah, we've had some people in Capitol say, who are you guys really? Okay. Who pays you? We've said, nobody pays us. We'd love to get paid. Will you pay us?
So getting on to the next question of this task force. We've answered, can you solve the problems with growth? Yes. You need 1 to 1.5% more, which means you need 378 to whatever business investment.
And being 1% more, so with our GDP being, say, like, it's right now 1 point.
No, I'm saying from the CBO baseline forecast, which is 2.2, you increase that by 1%.
So that's,
You get to 3.2. Maybe it's higher. The only way to know for sure is to have the Social Security's trustees help determine this target growth rate. Then we have an actual. But if you want to go with 1% more, then we're talking about 3.2. If you want 1% more growth, it's $378 billion of business investment. If you want to make sure that benefits the 100%, you have to stabilize the dollar. Next question is, how do you roll this out to the electorate? And here I think we have a little bit different view than most. Depending on who we talk to in Washington, the younger the staffer, the more of an instant reaction we get to say, oh, you'll never be able to explain this to the low information voter. You got to really dumb it down. It's like, wait a second. The electorate is a market. And our market's sophisticated or not. Our market's incredibly sophisticated at collecting and digesting and disseminating information in ways that a single person might not be able to comprehend. Of course it does. Look at the stock market. Is the average investor sophisticated? Is the market overall sophisticated? Yeah.
Yeah, but they live in an atmosphere where they're used to maintaining power by faking the market out.
That's exactly what it
They're
is.
faking out the electorate so they can stay in power. You said it yourself.
Well, but we know that.
I know you do.
So why do we play by the same rules? Why do we poll a Gruber? I mean, it was Gruber that said, oh, America is so dumb, you got to fake them out on Obamacare. Why do we insist on playing the same game and talking down to the lowest common denominator
I agree.
as opposed to talking to the electorate and say, look, the electorate works. It's a sophisticated market. I'm going to shoot straight with it, and I'm going to count on you to take the story to people in your network, and you'll find a better way to explain it in a way that relates.
No, but I was responding to your anecdote that you go to the young staffer and he says, oh, you got to dumb this down. Well, he's telling you that you got to dumb it down so that he can stay in office.
Well, that's,
So now how do you deal with that guy? Because you got to deal with him.
well, we're trying to go around. I mean, we work with a number of staffers, but we're not going to let that kind of attitude detract us.
So
We want to make the case that this growth task force needs to communicate to the electorate. Shoot straight. Don't dumb it down to the least common denominator. I'll just give you an anecdotal example. We go in with these slides, and we started out by trying to get a meeting with a member saying, I want to talk to you about monetary policy and Fed reform, which is kind of hard to get meetings. Not a lot of people are interested in that. We go through and we're talking about this from kind of a technical standpoint. Somebody who was the listener said, oh, this looks like a way to end wage stagnation. We're like, exactly. You mind if I use that? So in the next presentation, we say, we want to get a meeting, we have an answer to end 40 years of wage stagnation, and we start getting meetings like that. We tell the story the same way to the next person. And they're like, yeah, this looks like the war on wages to me. I'm like, wow, that's kind of catchy. I wouldn't have thought of that. But that's kind of an anecdotal example of letting the market work. Tell the story. Someone will find a better way to relay that to the next guy. And someone will come up with a better way even to relay it to the next guy. And before you know it, there'll be a catchy slogan on Facebook that none of us would have thought of, and it's going around like wildfire. Let the market work. The market understands we can solve our problems with growth. The market gets that.
A question is, so does that mean that the growth of wages is, acts as the measure of how well you're doing?
How well you're doing
How well
in terms of
you're
who's
doing in terms of creating growth?
Oh, I think so. I mean, the goal of every policy should be maximum real GDP growth, period. Nothing else is important.
So is that reflected
But for
by
that
the
growth to be
in wages?
genuine, it's got to lift income of the 100%. You're always going to have inequality, and this gets into a tricky, side with the left. As long as you have me and LeBron James, there's going to be inequality.
Oh, sure.
Right? And God forbid, we don't want to make LeBron James carry a backpack and army boots just so I would look like I'm a comparable basketball player. You're going to have inequality, and that's fine. I mean, that's actually good because Steve Jobs creates abundance for the rest of us.
He didn't go to college.
Yeah, well, poor guy. So obviously we don't want to do anything about that. And we don't want government policies to get in and think they can do anything. But there is a form of inequality that's intolerable. And that is when the Fed raises interest rates to stamp out wage growth. Back in the earlier period, you had trendline growth. This was 3.9% growth during this period, right on the 180-year trend. And everybody did well. Just because that trend is flat doesn't mean you don't have upward mobility either. That's the bottom 90, the bottom 9 deciles collapsed into a single line. So you could still enter at the 10th percentile and relative to a flat trend, work your way up to where you're in a higher decile and have income growth. That still goes on. It's just in the aggregate, we're never going to have the kind of across-the-board prosperity we need as long as we continue to let the Fed treat wage growth as inflation.
Usually 48 through 70, that's kind of an unusual period because of the fact that the rest of the world was on our knees after World War II. Are you saying that is the norm before then also? Before World War II?
Well, it's a good point. I used 1948 because that was the first year of full implementation of the post-war monetary system. Bretton Woods.
Okay.
So I think that the beginning period is relevant because of that. And 71 is the period of the dotted line, which was the end of Bretton Woods. So I tried to compare one specific monetary regime to another. If you back it up, then you get distortions where you had World War II, you had Great Depression. There were other things that it lacks comparability. So if you broke down the monetary systems, you'd have the classic gold standard that went up 80 years until 1913. Then from 1913 to 1922, we had a different kind of gold standard. From 1922 to 1935, we had a different one. From 1935 until 48 was dominated by the war. So here you at least had a clean period to compare to.
But you get my point that was unusual because of the fact that most of our industry was fat, dumb, and happy, didn't have any competition.
No, but think of this too. How in the world did the rest of the world rebuild out of the rubble of World War II without a stable dollar? I mean, if you go back and look what Japan did and what Germany did, they were written up at the time as absolute miracles. And the reason is that you had a stable dollar that facilitated the kind of investment that was necessary, to rebuild that. Yeah, back there.
We've got a situation where everybody's running around saying raise the minimum wage, raise the minimum wage right now, which obviously
Yeah, that's what I
is
was-
going to increase spending. But how do you tell the difference between income, wage growth that is
today, the conventional wisdom today, is we've been conditioned to think that wage growth is inflationary. If wages go up as a business owner, that's going to put pressure on your profits. You're going to have to raise prices. So we're kind of fighting an uphill battle. I would say this, if you stabilize the dollar, all wage growth is good. A stable dollar means a stable unit of account, a stable unit of measure. If you're a business, you can invest more confidently because your material costs are going to be stable, and the future cash flows that you're going to get from that investment you make are going to be denominated in the exact same dollars that you're expending today. And as a result, you don't have to spend on hedges and shelters and things that are good for Wall Street, but not good for Main Street.
And so-
And during this period, you had stable profit margins. From the beginning of the period to the end, you had stable profit margins. You had stable oil prices. Oil was a flat line. Other commodities had some wiggle to them, just based on supply and demand factors and other, but for the most part, the trend in material costs was flat. Wages went up with productivity, because you had a stable dollar, you had better investment, better productivity, and profit margins at the beginning of the period were about the same as they were at the end of the period.
Question? How onerous?
But let me back up and just add one thing. So picture the Fed. They basically have two choices. They can let food and energy prices rise and stabilize wages, and they'll keep the CPI and the PCE deflated from going up. Or they can stabilize food and energy prices and let wages go up to stabilize that index. In the first period, they stabilized food and energy. They actually stabilized the dollar against commodities, which gave us stable food and energy, and they let wages grow. And as long as productivity keeps pace with wage growth, everything is fine. They've reversed that. They allow the dollar to float. They neglect the dollar, really. And as a result of dollar neglect, it drifts downward, which means upward pressure on commodities. And when that inflation starts to work its way through the price system and finally catches up to wages, that's how they justify saying, oh, can't let this go any further, and they stamp it out. So they allow the inflation to happen in one price. And labor is a price just like any other good. They allow it to happen, and in the prices that react first, it happens. And then as it starts to filter through the rest of the economy, then they cut it off, and that's really the issue.
If you look during the 30-year period when we've had this regime of suppressing wages, effectively wage growth, we had the 3 periods where wages actually increased until the Fed stamped it out. If you see, the middle one was by far the longest. And part of the reason for that was Alan Greenspan was the Fed chairman, but there were a couple of people on the Open Market Committee in the person of a guy named Wayne Angel and another one named Manley Johnson, and they were kind of old school price rule economists. And they, in fact, had very strong personalities. They prevailed upon the chairman, who was interested in consensus, not to raise interest rates when they began seeing wage pressure, but in fact, they stabilized the dollar not against gold, but against the basket of commodities. And they, the result was spectacular economic growth. I mean, we remember the 90s as being, the golden age, the booms, that kind of thing. If you remember, oil was $10 a barrel. Mm-hmm. The Saudis wanted our dollars a lot more than we wanted their oil. But everybody was doing great. It was the one and only time in decades that we actually cut a non-defense expenditure in actual dollars, and that was welfare reform. And, the attitude at that time was, if you're not doing well now, it's probably your fault. The left couldn't muster the outrage that they do every day now, the results. And it wasn't then Johnson and Angel rotated off the Fed board or retired or whatever. Alan Greenspan discovered his inner maestro, promptly tanked the dollar and the economy. And what we've got is the result of that. So wage growth is not inflationary. Back on the other side of 1971, when a corporate executive, when a business owner a manager felt wage pressure, what they did was they said, wow, gee, maybe I better buy some new machinery and get more productive, or move my plant near my market, or find a new supplier. They did what a business manager does. And the result was, there 23 years of stable profits and rising income for everybody. There was none of this, what do they call it, income inequality. You go back and you look at this, and the left says absurd things about income inequality, raise the minimum wage,
That's what
higher taxes, that kind of thing. And when we, on the right, either ignore it, or even worse, we say it's a good thing, we're wrong. It's a bad thing, but it should be our issue. We should say, the government's causing it. Back
by
when the
the way-
government didn't do it,
Notice how this accelerates here, and you have another acceleration here. Those are two policies of the government. 1986, we lowered personal rates below corporate rates, and it prompted a huge flood of C corporations converting to S corporations. And all that did is shift the location where that income is reported without changing income at all. So it made it look like there's a boom of income for the top 10 that was just tax related. The next one started in 1993, and you may remember Bill Clinton's tax increase. And in an effort to crack down on so-called executive compensation, they had a millionaire surtax. And they said, you could be a Hollywood entertainer and make $1 million, God bless you, but God forbid you're some evil corporate executive, we're going to tax you if you make over $1 million. Except, there's always a loophole. They said if the excess above $1 million comes from incentive compensation such as stock options, then it's okay. Well, that ushered in an explosion of stock option issuance. Every single incentive compensation plan in the country went from whatever it was to options. And couple that with a strong stock market, and you had another explosion where options take basically stock market gains and convert it to ordinary income.
All right, so
If you adjust for those two, there really isn't that big of a
what
difference.
you're saying, now, most of us that studied some sort of economics understand that wage growth without increase in productivity is inflation. What you're saying actually is that wage growth drives increased productivity.
Well, if you have wage growth stronger than productivity, you could have a profit squeeze.
Yeah, but that drives productivity, because to avoid the profit squeeze, you've got to find a way to increase
Exactly.
productivity.
Exactly. So the Fed shouldn't be in the business of preventing profit squeezes,
Okay.
right? So here's the thing. If the Fed is going to cause inflation, every price in the universe is ultimately going to adjust to that. A 30-year contract is going to take 30 years to reprice. If you have a 5-year lease, it's going to take 5 years before you can increase that price. So the adjustment process in the economy is slow. And it's based on the average maturity of contracts. There's some things that are globally traded in world markets, in all currencies such as commodities, that are a pure measure of the dollar's value because they're the first to adjust. And a pound or a ton of copper today is exactly the same as it was 100 years ago. You can't say that about a computer, a TV, a home, because there's so many improvements along the way. Commodities are a plain expression because they don't change their character. So they give you the best signal of the value of the dollar. Now, if the Fed is going to cause inflation, the 5-year contract is going to take 5 years to reprice. Other longer dated, and wages are somewhere in that intermediate term. It takes time for wages to respond to inflation. So in that case, I would look at that and say, that isn't real wage growth. That's nominal wage growth. That's just trying to catch up to inflation. So it's not that wage growth is bad, it's just simply a response to something that already is bad. So if you have stable commodities, that means a stable dollar, then any wage growth you get is going to be good. Now, if it's causing one business a profit squeeze, let's let the market sort that out. And if one business figures it out and the other one doesn't, well, then the one that figures it out should get rewarded, and the one that doesn't shouldn't get rewarded.
Is there any way to stabilize the dollar at this point?
Sure. you would announce today and say, beginning 6 months from now, so beginning, what, August, the Fed will begin conducting open market operations with the sole objective of stabilizing the dollar against a 12-month moving average of a broad commodity index, plus or minus a range of 25%. You announce that today, and you'll have immediate market reaction today. Anybody who's holding commodities as a hedge against the dollar has no reason to hold commodities, they get out. Anybody who's holding these real assets and shelters as a hedge against the dollar gets out. You get this adjustment process where commodities will be in a downtrend, and what you're trying to do is find the level of commodity prices that's consistent with today's price level. Right now, they're elevated relative to the rest of the price level because they're a hedge against inflation. Same with the price of gold and silver and other things like that. So on that announcement, as people get out of those hedges and shelters, the prices are going to come down. And I don't know where that equilibrium is going to be. I could guess, but my guess is only one of millions in the market. Let's let the market decide. Those prices will come down, and they'll find a level where they start to stabilize. And at that point, you can say that must be the level of commodities that's consistent with today's price level. So you would instruct the Fed to use a range, just again, as an abundance of caution. If commodity prices break out of the range, you drain to bring it back down. If they fall below, you add liquidity to bring it back in. And gradually you squeeze that range down until you have level commodities that's consistent with today's price level, where the market did the discovery process, and then you can stabilize it. And you can get to the point where if a commodity index went up a penny, the Fed would drain a little bit. If it fell a penny, they'd add a little bit, and you could keep a nice steady line, which would mean a steady line for oil, a steady line for all the other, commodities that go into it.
But wouldn't the liberals fight that tooth and nail because that would reduce dependency on the government, and that is essentially.
You'd have to do what they did in the Godfather movies. You'd have to make them an offer they couldn't refuse.
It's beyond the scope of this discussion.
Well, so the Financial Services Committee, the key committee chairs and the committee sub-chairs could go to the Fed privately and say, look, we can do this one of two ways. You can stand with us on the podium, and we can all be happy together, and you can say, hey, it's Congress's job to give the Fed the mandate, and us hardworking civil servants at the Fed will do the best job we can, regardless of the mandate that Congress gives us. And if they give us this mandate that we have now, we did the best we could. If they want to give us a new mandate to stabilize the dollar, we'll do the best we could. And you give the Fed an opportunity to maintain kind of this proud, image facade. And if they refuse you on that, then you say, fine, we're going to go to the electorate, and we're going to say that you're the reason we have 40 years of income stagnation, and we'll get a mandate, and we'll force it down your throat. So, you have a preference on how you want to do this? And I
You've been
doubt,
suppressing the wages of the American worker for 40 years.
I understand.
Everything. You, the Fed, Janet Yellen, you suppressed wages. I saved the world. You saved it by suppressing the wages of the American worker.
Yeah.
Look at this. And we need to get that into the
Lexicon, yeah.
lexicon, exactly. And at least on Capitol Hill, we're getting it. Now, getting it beyond that, it's a process. The thing, though, in this, the political part of it, again, in that middle section, where there was very strong growth for the whole economy, for everyone, the market liked it. And again, they didn't care what Bill Clinton did in the Oval Office with a teenager, because they were working overtime and were doing just fine. Clinton avoided impeachment. They were willing to cut welfare. They were willing. Things were going well. What we need to do, and we're way down here now. We're not up, way down here. If we can start to deliver that growth, we can achieve a mandate that will allow us to take, further steps. The problem is we've got to have the dexterity and the ability and the courage to do that.
why couldn't we announce today that, number one, we've acknowledged the problem. 40 years of stagnant income for the bottom 90% is the one and only problem. If you don't fix that, you're not going to fix anything else. And if you try to fix anything else, like the tax code to repeal Obamacare, it's not gonna change this. So we acknowledge the problem. That's the first step in solving it, is just acknowledge what the problem is. Then you pledge to fix it. And if I were running for president and I say, vote for me, I'm gonna take that 97 cents, that dollar of 1982 income that's at 97, and I'm gonna grow it. Every single thing I do is gonna be based on driving income growth for this driving majority. I wanna get it to $1.05, and then I want you to reelect me. When it gets to $1.10, we're scrapping the whole entire tax code and we're starting over. Why not telegraph this to them? I don't know that you would do it in that order, but what's wrong with saying, I'm gonna pledge to make your bottom line my bottom line, and when I deliver, I want you to support me. When I deliver more income growth, I'm gonna need more power to keep it going. And then I deliver more income growth, and I say I'm gonna come back, and I'm gonna ask for more power so I can get this done. Because if you think about it, if that's your lens for looking at everything, the tax code is a huge killer for economic growth. And if you fix the dollar, that economic growth is gonna benefit everybody. Obamacare, what do employers spend right now on healthcare? 15,000 a worker, some ridiculous number? If you had a solution for that, that's extra income that would flow through to employees. If you deregulate, you take that regulatory burden, which is now larger than the combination of the income, personal income tax and corporate income tax combined, you have a heavier regulatory burden. As you start squeezing that down, it's going to be more economic growth and income for everybody. But at this point, we have zero credibility because nobody's experienced any income growth. If you get them back to this, and this didn't happen in that long period of time, it's 6 years. In 6 years, could we take that and do that again? But this time have our ducks in a row, and at this point say, when we get you to here, this is what we're going to do next, and this is what we want you to support us on. Because when we get you to there, here's what comes next, and when we get you to there, that's what comes next. And telegraph this so it's transparent, it's accountable. I mean, that would be something unique in Washington. Yes?
Do you kind of agree that no matter how many congressmen you get to understand this, that the only way to get to the public, the electorate, will be towards our candidate or a candidate, bringing
Yeah.
it out? And if so, who do you think out of the group that's thinking of running right now would be the best or would agree with this the most?
That's a good question. There is no substitute for presidential leadership. I mean, there's nothing like it. So if you had that and you didn't have the Congress, you could still get it done. If you have a group in Congress, but you don't have it here, it'd be hard, but I think you can still get it done. The key is whether this group in Congress takes the right message to the electorate. If you take the message.
But nobody listens to Congress. The only time I
Because
see
they don't have
Boehner or
anything good to say.
anybody on TV, it's on Fox. So
It's-
who's going to hear the
it's
message?
because- It's because it's reactive. It's this, there's another scandal from Obama, or Obama does this, and we scramble to try to provide a counter and hold back, the onslaught. We don't have an offensive message.
I agree.
Nobody has it. If we had an offensive message, people will listen to it because they do want to hear that. A poll that Doug Schoen and Pat Caddell did, they're two Democrat pollsters that maybe nowadays are considered former Democrat pollsters. Overwhelming majorities. They want new leadership. They want new ideas. They want new energy. The electorate is starved for this. They get it.
That's
They
what
just want to
happened
see
in
that something
2010,
Congress
12, and 14.
What's that?
That's what happened in the midterms of 10, 12, and 14. They're still looking for, the promised land, and, all right, we'll give you another whack at it.
And you know what they want? They want income growth.
Yes.
They gave it to the Democrats when they delivered in 1960. They gave it to Republicans. At this point, the Reagan prosperity, at that point in time, we had all the power in the world. The electorate said, hey, you know what? Republicans have figured out how to deliver the only thing that we care about. We're going to give you all the power that you need. And then look what we did to it. So we have a little bit of, repair mode.
So
to
finish
repair.
my question then. Who do you think could
Well-
give this message?
We met with a couple of campaign teams. We're going to meet with a couple of more campaign teams. We would like to get this to the hands of all the candidates.
I would think Paul Ryan would be the most logical.
He's not running.
Well, it doesn't have, but I'm
Oh,
talking
he
now.
should, you have to get him on.
We had a meeting with him, and he grasped this probably faster than anybody. He said, oh yeah, this is sound money, I know we need it. But then he gets bogged down into, well, what do I tell the Taylor Rule guys, or what do I tell? And our message to him was simple. You have your dream job. The country's going to get the dream tax plan of Paul Ryan. And it's going to end one of two ways. We're going to get 3 or 4 years of the best growth we've ever seen, and then the Fed's going to stamp it out, and then everybody's going to say Paul Ryan's plan didn't work, it was all, whatever the left is going to say. Or we can get the kind of growth we had from 48 to 71, and then Paul Ryan's going to, he'll be the next guy up on Mount Rushmore. I don't think he's going to run.
No,
Well,
he's not.
you don't think he's going to run?
No.
He already said.
Yeah, he's not running for president.
Oh, I
He's-
know
yeah.
that.
But he
But
can
I'm
still carry
talking
the
about
message.
now. Would he not be the logical person to at least make inroads with?
Well, our assessment is the best way to make inroads. You have this new House Freedom Caucus that was formed by Jim Jordan and 9 other co-founders that are rock-solid conservatives. They now have 30 members in this caucus. And if you have, all you need is 28 to block
Just
something.
say Jim Jordan, that's enough.
Well,
Yeah.
that was, I mean,
Yeah,
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 he
that's-
had me and Jim. So they have enough where they can block it. And I think a lot of people are looking at them saying, well, all they're going to do is be obstructionists and be a thorn in the side of leadership. Well, what if they came out with a positive growth agenda like this, that just laid it out, said we can solve our problems with growth, we only need 1% more. To get that, we need $380 billion in business investment. If we stabilize the dollar, it's going to help everybody. And our goal from now on is to take all of our policies, tax reform, Obamacare, regulations, et cetera, and reframe them in terms of how they can deliver income growth to the striving majority. I think people would listen to that. Huckabee's team, we're in conversations with. Ben Carson's team, we're in conversations with. We have a meeting coming up with Scott Walker. Okay.
But what it comes down to is there's 3 things we need to do. We need to fix the regulatory regime, improve it, we need to do tax reform, and we need to fix the Fed. And there's brilliant work being done on the regulatory side. There's some things that have passed the House over the last couple of years. There's, energy things. There's, they've got to work on healthcare and that kind of thing. But people are working on that. We haven't tried to work on that. Paul Ryan's going to have a tax plan. And his tax plan that he's published so far is quite good. Now, when we talked to him, we said there's a couple of little things that we think, if you put it, would make it even better. And he said, great, we're not writing the plan until the summer. We love to hear, give me your ideas and that kind of thing. We think there'll be a very good tax reform plan. Nothing's going to pass in this session of Congress.
I'm just saying that I think
But the
until
third-
it comes to a new president,
But the third thing is then we have to fix the Fed. And if this growth task force and Jordan and those, we can get a bill written and, seriously considered with some traction and some publicity and whatever. And my fantasy, and it is a function of how old I am, that my fantasy is that in the first 100 days of the new Republican presidential administration, we'll get those 3 things passed. And the result will be economic growth that will cause us not to recognize the country. We've talked about, for the Growth Caucus, having a goal of 4% annual growth for 20 years. And if we do that, you will not recognize the country or the world. Right. The differences will be tremendous. If you went back to this graph and you just extended it that 23 years, the median income adjusted for inflation in the United States would be somewhere between $102,000 and $105,000, something like that. Adjusted for inflation, there would be no budget deficit. There'd be no entitlement crisis. The immigration crisis that we would have would be, we can't get enough people out of Central America to come here and fill the jobs we've got to fill.
and you're saying that I'll be able to open Bobby's burqa store?
There you go.
Because all the
So
Muslim ones
the
are
bottom line is,
sober?
Yeah, right.
any problem that we have left that this doesn't solve directly will be imminently more solvable, okay? But we've got to get those several things done. And we've got people on Capitol Hill who agree with us, and we're doing things about it, and we're in a position to do things about it.
I'd like to see all the presidential candidates unanimous in their support for stabilizing the dollar and committing to generating income for the striving majority, the same way we're all opposed to Obamacare. This shouldn't be an issue that differentiates one candidate from the other. Personally, if one candidate was on board with this and the rest weren't, that would be my guy.
But aren't you assuming that you have enough politicians in the House, in the Senate, and the presidency that will allow a recession to run its course? I'll say publicly, in order for us to grow these rates that we're proposing, you have to suffer through some pain. We're not going to do anything.
I don't think you have to. I don't think you have to. I think if you made the announcement today that we're going to stabilize the dollar and here's the path for doing it,
I understand what you're saying.
You'd have
I
a
agree with
4 or 5%.
What do you do when you have a severe recession? And for example, Bush, he quit retiring. I think, Obama made it far worse, but the point I'm trying to say is that there's a fear in all these politicians of having people out of jobs and voting against it because they're in office already. How do you solve that?
well, there's a difference. The recessions that we've had in this post-1971 period have all been because of too tight monetary policy. A stable dollar by definition means it's neither too hot nor too cold. It's exactly what the market wants. So a stable dollar means the market will decide the money supply.
So I
The
understand.
market will decide interest
That's not my
rates.
question. My question is, how do you deal with the politicians hearing people screaming, do something? Do something to fix my loss of job.
There's only one thing to do. Stabilize the dollar and get income growth to everybody. You don't have to go through a recession in order to come out. I mean, growth would pick up immediately. The very first quarter after the announcement, we'd have the best GDP growth that we've had in, a dozen years. And there's no reason why that wouldn't be able to sustain. The people that think that the economy can only grow at 2.5% are stuck in these models that assume the economy is in equilibrium, that we're in a closed economy in equilibrium, and that everything, all the resources are fully utilized. Is the labor market, are we at full employment? Where everybody's at their highest level of employment, where we have no person flipping burgers that could otherwise be a short order cook? There's huge slack in the labor market that could, there's a lot of growth you're going to get from there. How about in terms of financial assets? Are all the financial assets at their optimal allocation? No, because you have trillions that are tucked away in all these hedges and shelters. Are all the physical assets at full capacity utilization? No. So you have room to generate the best growth we've seen in 40 years and sustain it for who knows how long. Now, along the way, you're going to get some ripples, but before the Fed, any of these so-called panics, they weren't called recessions, they were called panics because they were over. And they usually, by the way, started when someone got word that somebody was going to devalue one of the banknotes. That's like, I better get my money out of there. And people would run, kind of your classic bank run. And as soon as the sun came up the next morning, a lot of times the economy was back to rip-roaring growth. So there's nothing to repeal recessions. We're going to still have them, even with a stable dollar, but they're going to be short-lived, and then we're going to get back to robust growth.
Quick question, what impact has this printing of money that you hear about had, and do you worry about the $12 trillion increase in the deficit to 19 trillion?
In the deficit?
In the debt.
The debt, I mean.
Okay. Well, the amount of money that's been printed is a little bit misleading because most of it is sitting in excess reserves, where the Fed is paying banks to sit on excess reserves. If that were out in circulation, of course, prices would be higher and we'd be in the midst of inflation. So, yeah, if you adjust that for the amount of excess reserves, I think the Fed is actually tight. When they tried to do QE, they had the opposite impact. They were tight through QE when they were trying to loosen. In fact, if you looked at QE1, QE2, Operation Twist, and QE3, you had 4 different maneuvers, And if you look at interest rates, employment, and output, so 3 columns and 4 rows, you have 12 variables. They were only successful in one of them. I mean, they struck out in 11 of the 12. If you created a grid, they struck out, you got X's in 11 out of 12. They did the opposite, and it gets really technical how that happened, why it didn't work. But long story short, I'm not really worried about printing money. I don't see any market signals that indicate it's an issue. And the debt is only a problem if we continue to grow at 2.2%.
Right.
You know, if you do a present value, so think of the debt like you would your balance sheet, right? You have a debt called your mortgage. You have a flow called your mortgage payment. But you also have an asset on the other side of your balance sheet that equals out with your mortgage, and that's your house. Well, if you look at the nation's debt, it does look big, but what is the nation's asset? The nation's asset, or the government asset, if you want to look at it that way, is 17% of GDP forever, right? That's what they take of GDP. If you do a present value of that at 2.2% growth, and you add all the unfunded obligations, let's call it 100 trillion. If you do a present value of the government's take of GDP at 2.2% growth, it works out to about 600 trillion. So 600 trillion versus 100 trillion isn't that comfortable of a margin for me. But if you increase the growth to like 3.5%, 4%, it doesn't even compute. The debt is insignificant compared to, you know, and that just is another way of reinforcing the power of growth. So do we want to worry about debt or not? If we want to worry about it, well, we accept 2.2% growth and it becomes a real problem. At some point, it's going to catch up to us. But if we increase growth, I wouldn't worry one bit about the amount of debt we have. We'll have an economy so strong that we can shoulder that debt.
Okay, unfortunately, we're going to be thrown out of here in about 5 minutes, so it's almost 9 o'clock. Thanks, Rich, thanks for coming out. Thanks for all of you for coming out. The Talking Computer